in the studio now by Wole Oluwo, a financial analyst. Thank you so much, Wole, for being here.
Having me, Esther.
Now, well, I was going to, because usually I would ask, well, were you surprised? But then it looks like this decision came in line with expectations of analysts, perhaps in line with your own expectations too. But just share your thoughts on, when the meeting concluded and then when it was announced, 12% is what we're still at, 10 for the 10th consecutive time.
Let me start by saying that I thought the CBN would have used the opportunity of today's meeting to begin to trend down on the interest rate. That was my expectation. No matter how little, at least it would have shown the direction to the market, and the market would have picked it from there and begin to trend downwards as well. Having said that, I think it's important we also look at where we are with regards to the economy, how we got to where we are, and the transition we have to make going forward. In the first instance, I think we have passed the stage of the turbulence, we have passed the stage of the cleanup and trying to put structures in place, processes and all that. Dr. Kunjewala did that during our Obasanjo sojourn. Now we have also consolidated on stability, which is that a lot of the variables are within our control now. And the other day, the coordinating minister for the economy was reading out all those gains in terms of the reserves that have been accrued.
The macroeconomic indicators, yes.
The sovereign wealth fund, the growth rate, fiscal deficit limit and all that. No, those are good things. But the interesting thing in economics is that it's a trade-off. For whatever you have achieved, there's an opportunity cost of those things that you have failed to achieve.
Well, many analysts, economists believe that trade-off is not a very fair one, and that is perhaps too much of a price to pay, because it looks like growth, the real growth that the economy needs is being sacrificed just because we need to keep, one end of the coin of the other side.
No, I understand. Stable. I understand, but the point I was trying to make is this: we have achieved stability in our exchange rate policy. That's correct, but the opportunity cost of that, to me, is likely the foreign exchange reserves that we have not been able to grow beyond that threshold that Obasanjo left it. That is on one hand. We have achieved single-digit inflation, but the opportunity cost of that is the interest rate increase that we have also, resulted in, because they go together. As long as you bring down inflation, interest rates will go up, right? We have achieved growth, but we're not seeing the jobs, simply because we're not investing in infrastructure, we're not investing in those things that will make the job drivers to grow, agriculture, the manufacturing sector and the rest of them. So any way you look at it, the economy has moved from a position of cleaning up and tidying up to the position of stability and consolidation. But at this point, there is a need to make the transition to the next level. And that next level is what the economic team don't seem to agree with analysts. Analysts are of the view that the next level we need to move to is the level that can create jobs. But it's like wanting to go to heaven. There's a price we pay for that. We cannot create jobs until we begin to bear the costs in terms of some of these macro variables that we have achieved. You cannot keep all of them within your control. Some you will sacrifice in order to achieve what you believe the benefit of that achievement will outweigh the cost that you are bearing by sacrificing some of the stability of the variables. Because there's no way you can continue to have inflation at single digits and you will not have interest rate at double digits. But Dr. Kunjewala conveniently did not talk about interest rate when she was talking about.
It's something she's always talked about, the fact that at MPR at 12%, definitely that will make make it very difficult for the private sector to have easy access to credit. Now, back to the issue of jobs creation, you said we're not investing in infrastructure.
Yeah.
I mean, we know that on that end, that the jobs can come from there. But, on a daily... Regularly, we hear the federal government saying they're investing in this, in roads, they're investing in this construction, and all. We know these areas can bring in the jobs. Is it that they're not investing enough? Because we have a capital vote in the budget that's been dedicated to, for capital projects, roads, and some other major infrastructure projects. Shouldn't the jobs be coming from this end?
It will come. It's something that we appear over time. But it's the consistency of those investments that will make them to respond. Industries need more than roads. They need electricity. They need access to cheap funds. And they also need you to help them in terms of opening the export market. Because those are the things that would put them in a position to, help foreign exchange, maybe create more jobs and begin to expand output. But now, the structure that we run is too centralized. And that's why we're having this problem. If you look at the budget itself, you just mentioned the budget. Now, if you look at the budget itself, you will realize that a lot of the money in the budget goes into security on one hand. On the other hand, almost like 20% of the budget is also going into fuel subsidy. Yeah, the security I can understand because of the challenges we are having now. But the subsidy at close to 20%, for me, is not the best thing to do. Because what we are doing is just subsidizing consumption, which is not sustainable. Now, if you look at 20% going to security, 20% going to full subsidy, and then you have capital vote of about 35%, the rest goes to the current. So at Benicio, the budget is already challenged. Yeah,
but we are borrowing, aren't we? We're going to increase borrowing this year, especially on the external side. If we're going to borrow,
both sides. We are borrowing domestically. We are borrowing from the international markets. It is because we have used a lot of our own earnings to fund recurrent, fund
debt servicing, perhaps.
Debt servicing, oil subsidy, and the rest of them. That is why we need to borrow now to manage capital expenditure. There's no harm in borrowing. But the challenge is, the problem we are having locally, the local debt is also contributing. But our local debt, as you see it now, is about 6-point-something trillion. That is even much more than the budget for the year. That is on one hand. On the other hand, the local debt is also contributing to the problems of the private sector. So you have a dominance of the federal government in the foreign exchange market because it is virtually the only major supplier of foreign exchange into that market. That is a big problem. You have the federal government being very dominant in the downstream oil sector with regards to subsidy, the distribution, the production, and all the variables that goes in that. That is also another level of dominance. You have the federal government trying to, reduce its dominance in the electricity sector. Maybe that is a good thing, but I wish they can go the whole hog in terms of quickly, pulling out of that sector, as opposed to privatizing the distribution and generation companies and retaining 30% for the federal government in those companies. The problem with that 30% is that it might be a minority stake, but because it is government, it is going to exercise more influence and power, even more than the 70% stakeholders in those institutions. That is another one. In terms of dominance too, you also have the federal government being in control of all resources under the soil of Nigeria. And that is making states not to bring out their own resources, to export them. Then another level of dominance is now the intervention funding for select sectors, agri, aviation, and the rest of them. And why are we funding selectively? Because generally interest rate has gone up and industries are crying.
And that's the CBN's own way of saying, okay, let's see as a palliative, as it were. Okay, yes, we understand that we are a key contributor to the present situation, even though we perhaps our choices are quite limited. We hope to to look at better options, but we don't have that right now. So yes, take 200 billion for this sector, take 200 billion for that sector. But then again, that's one other argument that has been faulted by so many analysts. They say intervention funds is not enough to spur real economic growth.
No, it's not at all. Number one, it distorts the market. It makes it difficult for small and medium enterprises, to play in the market. You cannot isolate one sector and give it cheap funds and leave the other sectors to go into the market. It doesn't work like that. But by the way, I think they realize that the kind of choices that they have made, that is the central bank and the economic team, which is to pursue single-digit inflation and pursue stable exchange rate at about 150 something. They know that is what has created the problem, and that's why they are taking all these extraordinary measures. I wish we could achieve a situation where we begin to bring interest rate down, and there will be no need for all this intervention funding, because they don't really solve the problem. They create a lot of windows for loopholes. People can take the money and go and sell it in the money market and don't use it for the purpose that they were meant for. That is another one. The other dominant issue that the federal government also needs to address is the issue of the debt market, particularly the bond market locally. That is also creating a lot of problems for the private sector. So if you look at a whole gamut of all this, you realize that the economy still needs a lot of structural adjustments, particularly in those areas of dominance, and we can open up the market, make the market to be much more market dependent in terms of determination of pricing, in terms of determination of allocation of resources and the rest of them. These things are key, and it is when we do these things that the CBN can take that risk of saying, okay, now I've achieved single digit inflation, I want to move ahead now to see how I can begin to moderate interest rates. Because the argument was that as long as inflation was double digit, CBN was not going to...
No, that was the initial argument. But
that was the initial argument that the CBN will not come down on the MPR as long as inflation is double digit. But now inflation is single digit.
And yet, there's still no change.
I think what the CBN is worried about is the global environment, what is happening in Japan. Because I had the CBN governor on CNBC this morning. He's worried about things in Japan, what's happening in America, and the rest of them. But the truth of the matter is that the global economic environment is not going to change soon, no matter what we do. All this instability, slow growth, and the rest of them, they are going to remain in the foreseeable future because there's nothing happening in the global market that can create this change. So
but that's not affecting us as much as what is happening within
us. We are not a major part of the global system. Our market is not internationalized. A lot of the foreign monies are not in our economy. And then, whatever happens in the global market does not directly affect us in a significantly negative way.
In a way that will
in fact, there are some periods that it affects us positively. Like in the last 5 to 10 years, the global economy has given us the kind of oil price that has been above $100.
And capital flows that we've
so
seen
many years. And we're getting more revenues for selling the same quantity of crude oil. So the global economy is not going to change soon. And if we continue to, shape our fiscal and monetary policies and not be aggressive enough to take risk, thinking that the global economy will change and that is when we'll make the adjustment, it will not happen. In the next 5-10 years, the global economy will still be struggling. That is my